Warm welcome to all of you on my YouTube channel, The Desi Analyst. And I hope you must have watched Technical Analysis series part 1 last week. And if not, then click the link from description. So today is the second part of Technical Analysis series, and let's start with it. The use of trend. One of the most important concepts in technical analysis is that of trend. The meaning in finance is not all that different from the general definition of the term. A trend is really nothing more than the general direction in which a security or market is headed. Take a look at the chart. It is not hard to see that the trend in figure 1 is up. However, it's not always this easy to see a trend. Figure 2. There are lots of ups and downs in this chart, but there is not a clear indication of which direction this security is headed. Security means script, stock. A more formal definition. Unfortunately, trends are not always easy to see. In other words, defining a trend goes well beyond the obvious. In any given chart, you will probably notice that prices do not tend to move in a straight line in any direction, but rather in a series of highs and lows. In technical analysis, it is the move of the highs and lows that constitutes a trend. For example, an uptrend is classified as a series of higher highs and higher lows, while a downtrend is one of lower lows and lower highs. Figure 3. Figure 3 is an example of an uptrend. Point 2 in the chart is the first high, which is determined after the price falls from this point. Point 3 is the low that is established as the price falls from the high. For these to remain an uptrend, each successive low must not follow below the previous lowest point, or the trend is deemed a reversal. Types of trend. There are three types of trend: uptrends, downtrends, sideways horizontal trends. As the names imply, when each successive peak and through is higher, it's referred to as an uptrend. If the peaks and throughs are getting lower, it's a downtrend. Where there is little movement up or down in the peaks and throughs, it's a sideways or horizontal trend. If you want to get really technical, you might even say that a sideways trend is actually not a trend on its own, but a lack of a well-defined trend in either direction. In any case, the market can really only trend in these three ways: up, down, or nowhere. For more insight, see peak and through analysis. Trend lines. But before moving ahead, I would like to request you all to share this link with others, as you never know who will be benefited and who will learn by your sharing. And obviously, like and comment too. And I again request, kindly share this link with others so they can also learn. So let's continue with technical analysis series part 2. That is, now we are at trend lengths. Along with these three trend directions, there are three trend classifications. A trend of any direction can be classified as a long-term trend, intermediate trend, or a short-term trend. In terms of the stock market, a major trend is generally categorized as one lasting longer than a year. An intermediate trend is considered to last between 1 and 3 months, and a near term trend is anything less than a month. A long term trend is composed of several intermediate trends which often move against the direction of the major trend. If the major trend is upward and there is a downward correction in price movement followed by a continuation of the trend, the correction is considered to be an intermediate trend. The short term trends are components of both major and intermediate trends. So take a look at figure 4 to get a sense of how these three trend lines might look. When analyzing trends, it is important that the chart is constructed to best reflect the types of trend being analyzed. To help identify long-term trends, weekly charts or daily charts spanning a 5-year period are used by chartists to get a better idea of the long-term trend. Daily data charts are best used when analyzing both intermediate and short-term trends. It is also important to remember that the longer the trend, the more important it is. For example, a 1-month trend is not as significant as a 5-year trend. Trend lines. A trend line is a simple charting technique that adds a line to a chart to present the trend in the market or a stock. Drawing a trend line is as simple as drawing a straight line that follows a general trend. These lines are used to clearly show the trend and are also used in the identification of trend reversals. So guys, this is not only about stock market. Even if you are doing forex or commodities, this technical analysis will help you over there also, because the technical analysis is the same. As you can see in figure 5, an upward trend line is drawn at the lows of an upward trend. This line represents the support the stock has every time it moves from a high to a low. Notice how the price is propped up by this support. This type of trend line helps traders to anticipate the point at which a stock price will begin moving upward again. Similarly, a downward trend line is drawn at the highs of the downward trend. This line represents the resistance level that a stock faces every time the price moves from a low to a high. Channels. A channel or channel lines is the addition of two parallel trend lines that act as strong areas of support and resistance. The upper trend line connects a series of high while the lower trend line connects a series of lows. A channel can slope upward, downward or sideways, but regardless of the direction, the interpretation remains the same. Traders will expect a given security to trade between the two levels of support and resistance until it breaks beyond one of the levels, in which case traders can expect a sharp move in the direction of the break. Along with clearly displaying the trend, channels are mainly used to illustrate important areas of support and resistance. Figure 6 illustrates a descending channel on a stock chart. The upper trend line has been placed on the highs and the lower trend line is on the lows. The price has bounced off this line several times and has remained range bound for several months. As long as the price does not fall below the lower line or move beyond the upper resistance, the range bound downtrend is expected to continue. The importance of trend. It is important to be able to understand and identify trends so that you can trade with rather than against them. Two important sayings in technical analysis are: the trend is your friend and don't buck the trend, illustrating how important trend analysis is for technical traders. So next we will go with support and resistance. It is not like simple you think this is support or this is resistance. In support and resistance I will show you with chart different things. So next video part 3 will be of support and resistance. Stay tuned, learn well, watch twice. If you are not able to understand in one time, then watch it twice. And most probably I think I had made this very simple, easy to understand. I am also giving you charts so you can easily able to understand what is written and what is there on the chart. So I hope it will be very useful for you. So do comment and share your views. And also one thing, which new year gift you are looking forward for. You are desiring for a future trade, you are desiring for an option trade, or you want a cash trade in new year gift. Do comment that also in the comment box, and do share with others. Take care, see you next week.